Hello friends, welcome to Learning Sessions, and today in this video we are going to talk about the other financial services which are being provided by the bank, and this is related to the last chapter of the module D of RBWM, and that will be related to fourth module. And further, if you want to get all the previous videos of RBWM, do subscribe to our channel right now and press the bell notification icon so that you get updated whensoever we do upload the new videos. And the full course is available along with the full course videos, chapter wise previous questions, mock test, mega mock test, and the complimentary access to the ePDF notes of all the 4 papers will be given to you. So do enroll right now and start preparing for the same. We are having the mega offer where we will be getting the full course just for ₹1,999. So do enroll right now and start preparing for the same. And also on sign up, you'll be getting access to all the PDFs free of cost. So you can be simply sign up on our website jaib.learningsessions.in, and we'll be providing you to the free access to all the PDFs over there, right? So let's start the session over here, and it's related to other financial services and related to which are provided by the banks over there. So first of all, it's related to third party products in retail banking. Now third party products is related to, let's say, case that banks are providing the mutual fund or selling the mutual funds or insurance products. Okay, so that's related to it. That's related to third party products which are involved over there, and it actually refers to financial products and services which are referred to the customers by the bank, but those are not directly managed and developed by the bank over there, right? So those are not developed by the bank but are being sold by the bank to the customers, and further these products are actually sourced from the external partners or from the third parties, right? So the bank has actually, let's say SBC Bank is there, and they have actually collaborated with the XYZ company over there so as to provide the product to the customer base of the bank is dealing with, right? So that's the funda related to third party products. And the different type of products we are having, first of all, it's related to mutual fund business. It's related to mutual fund business. Now mutual fund is related to what? As we have discussed in the first chapter also, it's related to that, let's say case the money will be pooled from the investors, and now this particular money will be invested into different segments. Like it may be invested into debts over there, it may be invested into stocks over there, it may be a balanced equity fund, it may be a balanced mutual fund also, right? So there can be the different scenarios, right? And also if we look at the mutual fund, what are the different features? First of all, these funds are to be managed by the professional. A professional person is going to manage these funds, and further they will be having their own R&D department, research and particular development department will be there, and they will be looking at after all the things. So your funds are particularly managed by the professional over there, and further you are having a diversification because the funds are not managed in single security but they are managed in multiple securities, and also you're having economies of scale because these funds are basically worth crores of rupees, and economies of scale is definitely there because they are going to buy and sell large amount of securities at a single time. So the transaction costs are lowered in that manner, and also the liquidity is present because the RBI, the SEBI has actually given the guidelines related to that an exit option must be there, right? And also simplicity is there, like you need not to have a special knowledge related to the same. You just need to invest the money into some mutual fund, and the professional now will be managing the funds over there. So there is simplicity involved, and also tax benefits are involved if you basically invest in mutual fund schemes which are linked with ELSS over there, right? And further it's related to classification. Now let's have a look at the classification of the mutual funds. First of all, it's related to classification of the mutual funds by the nature of funds. If we look at the nature of the funds, it could be related to equity funds where the investors or the particular, let's say your investor or a particular manager will be investing the funds into equity stocks. That's an equity fund. And if they're investing into the debt securities like bonds or particular corporate bonds over there, then it's a debt fund over there. If it's a mix of equity and debt, then it's a hybrid fund over there. And also it could be a solution oriented scheme. It will be structured in such a manner that it will be providing a solution to the investors so as to basically reach their financial objectives. So it could be related to a solution oriented scheme also, and also it could be a retirement fund scheme where you are going to invest into some scheme which will be giving you benefit for a long term period over there, right? And it will be having a lock-in period for at least 5 years. So these all are covered under the nature of funds over there. And also it could be a children fund. It could be a children fund over there. And it is also an open-ended scheme where the investment is made by the investors in such a way that the lock-in period is of 5 years, and further it will be having the lock-in period till the child attains the age of maturity, so that you can be saving the funds or particularly making the investments for your children over there. Now these are actually related to a different fund scheme as per the nature over there. And the second classification is by the structure of funds. It's by the structure of funds. Now if we look at the structure of funds, it could be an open-ended fund. It can be an open-ended fund that it is not having any certain maturity date, and you can be subscribing to the funds or to the units of mutual fund, and further you can be repurchasing the same on continuous basis over there. And if you look at the closed-ended funds, in that scenario it's having a limited maturity period, and further it's not possible that you can be entering anytime and you can be basically having an exit option, exiting anytime. You'll be having a particular period where you can be subscribing the units of mutual fund, right? And further it could be interval funds also. Like they will be in case of interval fund, the interval fund will be allowing you so as to subscribe to the units at the multiple intervals rather than at the starting point. They'll be providing you the multiple instances where you can be subscribing the units over there and further repurchase the shares over there, right, at the different intervals over there, right? That's the case of interval funds. Now this classification was as per by the structure of funds. The third classification is by investment objective. It is by the investment objective. Now if you are having the growth scheme, over here we have the growth scheme. Now in case of growth scheme, let's say case I invested rupees 100 and I earned rupees 10 on it, right? Now in case of growth scheme, this 10 rupees will also be invested along, and further it will be invested along in the mutual fund over there. But in case of the dividend scheme, dividend scheme, you will be investing rupees 100 and further let's say you earned rupees 10 over it. Now 10 rupees won't be invested, only rupees 100 will be invested, and it will be paid as dividend to you, right? So that's a dividend scheme over there. Now definitely in case of growth scheme, there is a factor related to compounding which is available, right? And that is missing in case of the dividend scheme over there. Further it's related to mutual fund business by the banks over there. Now if we look at the mutual fund distribution model, banks actually utilize the mutual fund distribution as a part of their fee based distribution model. Now what do you mean by fee based distribution model? Now the banks will be selling the mutual funds on some particular trust over there, okay, and further bank will be selling the mutual funds and bank will be earning the fees based upon it. Let's say case that bank sold a mutual fund amounting rupees 10 crore, bank will be earning a fees amount. Let's say the bank earned fees of rupees 50 lakh over it, right? So that's a fee based income that the bank will be earning, right? And further income streams for the bank can be by various manner. It could be upfront commission. Upfront commission would be related to that initial payment from the fund houses, that the fund house will be giving you the upfront commission that you have not even sold any of the units till now, but still you'll be getting some of the commission from the fund house for selling the mutual fund. Okay, so that's related to the upfront commission. And also it could be trail commission, that ongoing payments based on the assets under the management. That's the case that whatsoever the assets, those are being managed by the banks over there, and banks is actually particularly doing what? Banks are marketing the same. In that scenario, banks are going to receive the funds or incentives on ongoing basis, on continuous basis over there. That will be providing a steady revenue stream to the bank over there, right? And further, the third one is related to mobilization incentives. Now when the bank will be promoting the sales of mutual fund and encourage the fund mobilization, in that scenario mobilization incentives will be paid by the fund houses to the banks over there. Further it's related to special incentives. Now extra incentives or extra rewards will be given to the banks for achieving extra specific targets over there. That's related to special incentives that can be there. And also collection charges, so as to collect the premium, or let's say so as to collect the amount from the customers, collecting the amount from the customers, the bank will be receiving some incentives. Okay, so that's the case related to collection charges. So bank may be receiving upfront commission, bank may be receiving trail commission, bank may be receiving mobilization incentives or special incentives or collection charges, right? Now let's understand the effective strategies for mutual fund distribution by banks over there. First of all, it's related to product. Now the banks must be strategically choosing the mutual fund products that they basically want to cater to their customer, because this product must be catering the diverse needs of the customer, right? The choice of product is very much essential and plays a very important role, right? And the second one, it's related to the risk profile, that how come the bank can become a very good seller of mutual funds. So the risk profiling must be there. So the bank must be understanding the customer's risk tolerance, that what type of risk the customers can undertake and what are the different preferences over there, so that the bank can recommend the appropriate mutual fund scheme to the customer over there, right? And the third one, it's related to opportunity. Now the banks, if we look at the banks over here, first of all, Now, whatsoever the pros and cons related to these mutual funds, those must be conveyed to the customers. We must be telling them that what are the opportunities available. We must be telling them what are the inherent risks involved over there, or what is the possibility of losses over there, right? That must be told, and that will make your selling strategy more effective. And further, it's related to people. Now, when we're talking about the people, it's not related to the internal people only, but also cover the external people. Internal people, basically it includes the staff members who is going to market the scheme, and external people is actually related to the customers over there. Now, success of this particular distribution of the mutual fund actually depends upon what? That the marketing staff must be understanding the needs of the customers, and also must be understanding the financial products over there, so that they can be effectively be communicating the product to the customer, right? That's related to people. And further, it's related to geography. Now, geography means like demographics, like the economic conditions, like the cultural factors. They can be influencing that in what type of mutual fund the people are ready to invest into, right? And further, what particular product they are liking, right? And also, if the bank is providing appropriate training to the employees, to the marketing staff, so that they can be learning the product, so that they'll be having the skills related to selling the product over there, they'll be having the knowledge related to product, definitely it will make it more effective. And further, it's related to education. Now, it's related to regular communication of the same thing related to your product to the customers. It can be by way of seminar, workshops, or online resources, or through the manuals over there, through which the customers can be better be understanding the product over there, so that they can make a informed decision. Further, it's related to attributes. So banks must be provide the investors with important information, that what are the different benefits, or nature of the product, or what is the risk profile of the product over there, what are the potential returns, and what is the suitability related to the financial goals over there. Everything must be given to the customer, so that they can be thinking about the same. And further, these all things will be making the mutual fund selling business more effective, right? And further, it's related to RBI guidelines on mutual fund business. First of all, it's related to operating through subsidiary or joint venture. So banks are actually restricted from directly engaging in mutual fund business, which is actually covering the risk participation over there. So if there is risk participation, bank cannot be selling the mutual fund over there. So risk participation is allowed only and only if the bank, let's say XYZ bank is here, and if XYZ bank over here is setting up a subsidiary, or particularly it's under a joint venture with other company over there, only that scenario it can be undertaking the mutual fund business with risk participation over there, not other than that, right? And further, it could be also related to operating through department. So the one operation is through the joint venture and a subsidiary, the other operation is actually through the departments over there. So the banks are actually permitted to handle the agency business in mutual fund companies with their departments, where some particular department of the bank is actually going to deal with the mutual fund business over there. Investor application related to sale and purchase of mutual fund will be taken, and further, this department will be taking the applications only, and after taking the applications, they will be forwarding the same to the fund or unit over there, or fund office over there, right? And further, related to the purchase of units shall be at the customer's risk only, right? Okay, and the bank should not be granting for anything, because the bank is not to participate in the risk taking over there. And further, no mutual fund is to be acquired from the secondary market or bought back from the customer for selling it to the other customers over there. That should not be happening at any case, right? So it's not the case. So whenever the customer is buying the mutual fund from the mutual company, we are just basically routing the application, and if the customer is selling the mutual fund to the company over there, not to the bank over there. Bank is just going to route the application. And further, it's not the case that the bank is going to buy or sell the mutual fund from one customer and is particularly going to sell or buy the mutual fund to the other customer. That is not going to happen in any manner, right? So bank holding custody of mutual fund. So it may also be the case that the, let's say case XYZ bank over here is in department business over there, and particularly they are selling the fund units of mutual fund to their customers. And also with the case that they are maintaining the demat account where they are maintaining the mutual fund units over there, right? So both the things are separate. These both things are separate over there and must be managed separately. It's not the case that bank is going to mix these two sectors over there. That is not going to happen, right? Further, it's related to the insurance business. Now, insurance is actually related to what? It's a contract between the two parties, where one is actually going to protect the protection, and for the other one is actually going to sell the protection over there. So person A, let's say he's a protection buyer and person B is a protection seller over there. Now person A will be paying a premium amount to person B so as to provide the protection to A. So as to provide the protection to A, right? And for the person B will be indemnifying the person A for any of the loss that will be occurring in on the happening of certain events or circumstances under the certain circumstances or events over there, right? That's the case related to insurance. Now, if we talk about the insurance, we are having the two types. It's related to life insurance and the other one is related to the general insurance over there. When we talk about the life insurance, it's a contract between the insurance policy holder and particularly an insurance company where the insurer promises to pay a sum of money in exchange for the premium, and upon the death of the person over there, insured person over there, or after a certain set of period over there, the company is going to pay the amount. Let's say case person A is having a life insurance and he has paid an amount of rupees 10,792 as a premium to the insurance company, and the company offered an insurance of rupees 1 crore. Now on the demise of person A, or when the person A will be deceased, the company is going to pay an amount of rupees 1 crore to the nominee of the insured person, right? That's the case. Further, related, if we talk about the life insurance types, we are having the term life insurance, we have the whole life insurance, endowment insurance, or the money back plans over there. Let's first of all discuss about the term insurance plans. Now, term insurance plan is actually related to what? That it will be giving the protection for a limited term of years over there, and further it terminates with no maturity value. It terminates with no maturity value. Let's say case that the term plan was taken by person A, and further it will be applicable till the age of 60 for person A. So now there are two conditions. If the person A is surviving even after 60 years, in that scenario there will be no maturity amount that will be paid to person A. But if let's say person A died before the age of 60, then whatsoever the sum insured amount that will be paid to the nominee of person A over there, right? So that's the case. And further after that, it's related to whole life insurance policy. Now whole life insurance policy will be covering the complete whole life of the insured person, and further person A will be paying the regular premiums, and upon the death of person A, the sum assured amount will be paid. The sum assured amount will be paid, that is a face amount will be paid, right? And further it's related to endowment insurance policy. Endowment insurance policy. Now endowment insurance policy will be providing the life coverage, but also it will be paying some money over the survival as a survival benefit, over there. Let's say case that the endowment policy plan was there, and further it was having a term of 20 years. Now if the from the date of particular enrolling into the policy, if the person A dies between 20 years, then the complete amount will be paid. Then the complete sum insured amount will be paid. And further, if the person survives even after 20 years, in that scenario, a fixed amount will be paid. A fixed amount will be paid as a survival benefit, right? And further, it's related to money back plan or cashback plan. Money back plan or cashback plan. So certain percentage of sum assured is returned to the insured person periodically as survival benefit. In case of money back plan, let's say case the company says to you that you are going to invest into the company for the first 9 years, and in the 10th, 11th and 12th year you will be paid amount rupees 50,000, and further after 15 years you will be paid this amount over there. That is actually what type of plan? That is a money back plan or cashback plan, that after some certain period as a survival benefit you will be getting something, and also on expiry of the term the balance amount will be paid as a maturity value, right? So that is a money back plan or the cashback plan. Further, it's related to annuity plan or the pension plan. Now what is the annuity? Annuity is actually related to a regular amount or a fixed amount will be paid. Fixed amount will be paid at a regular intervals over there. That is forming an annuity. Now in that scenario also you are going to invest a lump sum, and further you will be getting a regular income after that. That's actually an annuity plan or a pension plan over there, right? That's all about the life cover or life, particularly we are about insurance we were talking about. It was life insurance, right? And after that we are having the type related to the general insurance. We are having the other type of the insurance to be general insurance over there, that is not determined as a life insurance. That's a general insurance. Like we are having the health insurance, we are having the particular travel insurance, we are covering the motor insurance, that is covering the vehicles. Fire insurance, which will be covering the losses due to the fire or due to any other things over there, right? And further, now let's talk about the insurance business by the banks. So we have covered the different type of insurance. It was a life insurance, and for the general insurance we have discussed them both. Now let's discuss about the insurance business by the banks. Now, insurance business with the risk participation is allowed only through a subsidiary, like we have talked about in the case of mutual fund. That is, with risk participation is only allowed if you do follow the joint venture model or particularly subsidiary model, where you will be creating a subsidiary over there, right? Only in that scenario it is allowed, otherwise it's not allowed, right? And further, in that scenario, the bank must be having at least net worth of rupees 1000 crore. So the requirement is of minimum 1000 crore of net worth is mandatory. And for the minimum net worth after investing the amount into the joint venture or subsidiary should not be falling below 500 crores. That's a case the company was fulfilling the criteria related to 1000 crores over their net worth, and particularly they invested the money into joint venture. Now, after the investment into joint venture, the net worth should not be falling below the 500 crores over there. That's the case related to it. And also the NPA level, the net NPA level should not be lesser than 3%. Now, what is net NPA? Net NPA is actually gross NPA minus the provisions. It is gross NPA minus the provisions which have been maintained by the bank. That's a net NPA. So that should not be greater than 3% over there. And further, the bank must have made a net profit in the preceding 3 financial years. In preceding 3 financial years, the bank must have made the profit over there, and also the track record of the performance of its subsidiary must be satisfactory. If these conditions are met up with, that the minimum net worth of 1000 crore is there and should not be having net NP more than 3%, and the net profit in the last 3 preceding financial years over there, and also the subsidiary is working satisfactorily, in that scenario it's allowed that the bank can undergo the joint venture and the subsidiary position over there, right, with the risk participation in case of the insurance business. And for the banks undertaking insurance broking or corporate agency by a subsidiary or joint venture. Now, if you're going to basically undertake the insurance broking or corporate agency by a joint venture or subsidiary over there, in that scenario, the net worth should not be lesser than 500 crore, as I told you. And for the net NP level should not be lesser than 3%. And for the net profit during the last preceding 3 financial years over there, and track record of the subsidiary must be good. In that scenario, that is allowed that you can be undertaking the insurance business. Undertaking the insurance business with risk participation by forming either a subsidiary, either you are going to form a subsidiary or going for a joint venture over there, like PNB MetLife is there, that is a joint venture, right? And further, it's related to insurance broking services departmentally. Now, departmentally, as I told you, a particular department will be dealing with the same thing only. Particular department will be selling the insurances over there, right? And further, there shall be a board approved policy for the same, that what are the different rules, regulations, procedures that will be taken care of, right? That must be there. And also the bank is to obtain a insurance license from the broking license from the IRDA. Broking license from the IRDA is required. That is also important over there. And also it's mandatory for the banks so as to maintain rupees 50 lakh rupees of the particular deposit with some other bank, and further the lien of IRDA will be marked upon the same. The lien of the IRDA will be marked upon the same, and this deposit is to be made with some other scheduled commercial bank, right? And further, the bank shall ensure customer appropriateness and suitability. It's not the case that you are selling any insurance to any person over there. You must be informing the customer related to the same and must be telling all the pros and cons and related to insurance scheme over there. And further, standardization system must be there that we can be assessing the needs of the customer, suitability of the product for the customer over there, so that we can be processing the same, right? And further, the bank shall treat its customer fairly, honestly, transparency must be there, right? And further, the bank will be ensuring the performance assessment and incentive structure of the staff as per the IRDA guidelines. Why? So it's not the case that if a staff S1 will be selling 10 insurances, S1 will be awarded with rupees 10,000 over there. Such system should not be there. So incentives must be based upon as per the guidelines which have been given by the under the BR Act 1949, or as per the guidelines which are issued by the IRDA in case of the payments of commissions and brokerage or incentives, right? And the banks shall not be following any kind of the restrictive practices like forcing a customer to either opt the product, right? So those particular practices should not be there, and there must be a robust internal grievance redressal mechanism. So that if the customer is having any kind of issue, that must be dealt along with it, right? And also there must be a board approved customer compensation policy. So there must be a special process so that we can look for the appropriateness and the suitability of the particular product to the customer, so that we can assess the need of the customers. And further, there must be transparency, honesty, and we must not be following any kind of the restrictive practices for the same, and related to compensation to the employees over there. And IRDA license is to be obtained, broking license is to be obtained, rupees 50 lakh is to be deposited in some scheduled commercial bank with lien to the IRDA. So these were the different important conditions related to the same, right? If we are basically operating departmentally. And further, if the bank is working as a corporate agency, if the bank is working as corporate agency of the insurance company. Now, what do you mean by insurance company agency over there? That let's say case we are having a LIC, that is a life insurance company over there, and let's say case that bank is working as agency. Now, bank is a corporate entity and it's working as agency, so it's a corporate agency. It's a corporate agency. Now, what bank is actually doing? Bank is actually going to doing what? Bank is going to use its own network so as to sell the insurance products of the other company, and in that scenario the corporate agents can undertake and can represent up to 3 life insurances, 3 non-life insurances, and 3 standalone health insurers over there, right? So that's the scenario. And further, in that scenario, approval is not required for bank if the banks are going to work as agent on a fee-based service over there, right? And when a bank becomes a corporate agent for the insurance company, it is called what? It is called the bancassurance arrangement. It is called the bancassurance arrangement or bancassurance partnership over there. And corporate agent can also represent specialized insurance company. They can also be representing the specialized insurance company, like they are also representing the Export Credit Guarantees Corporation like ECGC, or Agriculture Insurance Corporation of India over there. They can also be representing the special insurances, right? So that's the scenario related to corporate agency over there. Now let's have a look at the group insurance products. Now, what do you mean by group insurance products? Like PMSBY scheme is there, Pradhan Mantri Suraksha Bima Yojana scheme, Pradhan Ministry or Prime Minister Suraksha Bima Yojana, or particularly PMJJBY, Pradhan Mantri Jeevan Jyoti Bima Yojana scheme over there, right? So that's about the group insurance scheme, where the insurance coverage will be provided to the group over there, and there will be a master policy related to the same. There will be a master policy related to the same, and this insurance will be provided at the competitive premium. It will be provided at the competitive premium, right? So first of all, it's related to PMJJBY. Now, PMJJBY scheme is actually available to all those persons who are having age of 18 up to 50 years, and further, once the person has enrolled, let's say there was person who was aged 48 and he has enrolled into this particular scheme. Now the person is to pay a premium, and after paying the premium, the person can take along this scheme up to the age of 55. So for the enrollment age is 18 to 50, but once enrolled, it can be taken up to age of 55 over there. And also the auto debit facility is available. And if we talk about the cover of this scheme, if there is the demise of the person due to any of the reason, even if the suicide is particularly if the person even suicides, that is also covered in this particular case. And the particular let's say the amount of insurance is rupees 2 lakh under the PMJJBY scheme, under the PMJJBY scheme over there. Okay, so the life cover of rupees 2 lakh is available for a period of 1 year, that is starting from 1st of June of the current year to the 31st May of next year. 31st May of next year, right? So that's the scenario. And further, the risk coverage is actually rupees 2 lakh in case of the death of the insured person over there, right? And the premium that is to be paid, that is rupees 436 per annum. That is rupees 436 per annum. And the other scheme that we are having, that is the PMSBY scheme, that is the Prime Minister Suraksha Bima Yojana scheme. Now, for the enrollment under the Prime Minister Suraksha Bima Yojana scheme, the age limit is from 18 to 70 years. 18 to 70 years. And further, it is accident insurance scheme over there. It is accident insurance scheme, and the premium amount is just rupees 20, and the coverage is of rupees 2 lakh. Rupees 2 lakh. So if there is demise of some person due to accident, or there is accidental death, in that scenario rupees 2 lakh will be paid. And further, if particularly there is let's say permanent disability, and let's say there is a permanent disability of one limb or permanent disability in 2 limbs, if the disability is related to one limb only, then rupees 1 lakh will be paid to the insured person. And if there is permanent disability due to the accident of 2 limbs, then rupees 2 lakh will be paid to the insured person over there. And if the person dies in that scenario, rupees 2 lakh will be paid. Okay, and also the term period is actually from 1st June to 31st May of the next year. Auto debit facility is also available. Nomination facility is also available in this scenario, right? After that, it's related to cross-selling. Now, what do you mean by cross-selling? Let's take the case that person A visited your branch and he is maintaining a saving fund account, right? And now you basically offered, now A is having the saving fund account, and let's say case that we are just selling him the mutual fund, right? Now that is a cross selling. And also it will be the case that we are selling a internal product, that our own product to the customer over there, right? That's also the cross selling over there. Now what's the main benefit? That it's related to when you are going to acquire a new customer for the new product, it will be covering a cost that is said to be what? That is said to be the customer acquisition cost. That is a customer acquisition cost, but that customer acquisition cost is actually not available when we are cross selling over there. And how it is possible? If you're having in-depth relationship with the customer over there and customer satisfaction is there, then definitely customer tends to purchase another product from you. That's a cross selling over there, right? So what is the role of cross selling? It the cost factor, the cost is reduced because the cost related to acquisition of cost, that is reduced, and also it improves the profits. So in general, profit per customer is improved because you are going to sell the product to your existing customer, so your overall profit from a single customer will be increasing, right? And also it basically increases the brand loyalty. And CRM, now CRM is actually related to customer relationship management. Now if you're using the CRM over there, which gives you 360-degree view of the customer, you can be looking at the transaction pattern, at the income pattern of the customer, looking into what basically he desires for, what he's looking for, and accordingly will be letting him use a proper product, right? So that's actually related to CM, that how it can be useful. And further, let's understand the strategies for effective cross-selling. Strategy for the effective cross-selling. First of all, it's related to robust customer database. That if you're having a very good customer database over there, that you are having each and every knowledge related to your customer database over there, definitely you can be selling them cross products, right? Further, it's related to customer understanding, that if you know your customers' needs and preferences, it will be very much effective. And if you have segmented your customers like high net worth individuals or something like, or other segmentation, definitely you can tailor the different products to the different customers over there. And also you'll be having in-depth knowledge of your product over there, so that you can be knowing that what type of customer may be particularly interested into this particular product, so that you can sell them appropriately, right? Then further, it's related to cross-selling communication. Let's say case customer A visited, so we must be telling them that new scheme is there. Let's say PMSBY is there. You must be enrolling into that particular scheme or something like that, and we must be giving the pros and cons related to same only to those customers who may be interested into this particular product, right? And for the internal training over there. Now, internal training is related to that, so as to train your staff. So as to train your internal staff, so as to equipping with the appropriate knowledge, so that they can be cross-selling the product, right? That's the main thing. After that, it's related to the depository services. So when we talk about the depository services, it's about the financial services which are actually provided by the depository institution. Now, depository institution is providing the safekeeping services, or dematerializing or rematerializing services, or particularly transfer of securities in electronic format, which we basically say to be dematerializing services over there, right? Or taking a record of the particular financial securities over there. So these services are provided by the depository institute over there. And depositories such as NSDL, that is a National Securities Depository Limited, or CDSL, that is a Central Depository Services Limited in India, they actually do play a very crucial role in the same. Okay, so when someone is actually providing the depository services, the NSDL and CDSL do play a very important role in the same. And further after that, it's related to depository services which are being provided by the banks over there, right? So this is actually related to the banks are acting as DP. So their role is actually DP, that is a depository participant. And depository participant is actually a intermediary between the NSDL. Let's say case we are talking about the different depositories, NSDL and CDSL. So banks will be acting as an intermediary between the same, between the NSDL, CDSL and the customers over here, right? So they will be acting as an intermediary, or particularly interface between the depositories and the investors, right? So depository services which are being provided by the banks, first of all, it's related to demat account is being opened, dematerialization services related to converting the physical securities into electronic format, and further so as to converting the electronic securities into physical format, that is a rematerializing, okay? And also electronic record maintenance. Let's say case a person has purchased these shares, now the record will be maintained by the DP, that is a depository participant over there. And also it will be related to account freezing, like investors can be freezing their demat account so as to prevent the debits over there, so as to prevent the credit or the both over there, so as to ensure the control over the same, right? So these services are being provided by the DPs, banks as a DP over there. First of all, it's related to demat account. Now, demat account is actually a digital account. It's a digital account which will be provided by the depository institution. So depository institution or the depository participant, they will be providing a demat account to the customers where the investors can be selling or buying or managing the different trades or financial securities, right? So what's the process for opening the demat account? You must be first of all choosing a DP, that is you need to choose a depository participant. You must be submit the account opening application. You must be submitting the KYC details over there, and agreements would be executed and for the charges scheduled whatsoever. And DP, that is a depository participant, will be opening the account and they'll be providing them with a BOID. Now BOID is actually related to beneficiary owner identification number. It is beneficiary owner identification number which will be provided by the DP to the investor. And it may also be the case that the investor may be having multiple demat accounts. It may be the case that the investor may be having the multiple multiple demat accounts with the same DP or with the different DPs over there based upon the preferences of the customer, right? And further it's related to power of attorney authorization. Now account holders can be authorizing the other person through the power of attorney so as to operate their demat account, right? So let's say a person A execute a power of attorney with person B over there so as to authorize person B so as to operate the demat account over there, right? And also they can be providing the freezing demat account services to the customer where the customer can be freezing the debit or credit or both of the same, right? And for the demat account of minor, is demat account of minor is allowed? Yes, it is allowed. But let me just tell you, if you are going to open demat account in the name of the minor, minor cannot be a joint holder in a demat account over there. The account will be operated only through the guardian of the minor till the minor becomes the major. Till the minor becomes the major, the account can be opened in the name of a minor, but it cannot be a joint account. It will be operated by the guardian only, right? And further, what are the benefits of depository services? First of all, safe and convenient holding of the services. Like I purchase shares of ABC company, XYZ company. Where to keep them? I can keep them in demat account. And further, immediate transfer of services if I want to transfer the services or selling the services. And for the no stamp duty on transfer of securities is there. No stamp duty is charged, right? The securities transaction tax is there, STT is being charged, but no stamp duty is being charged, and there is alienation of the risk related to bad delivery, fake security, because it's related to the physical securities. Okay, so these risks are involved with the physical securities, but in case of demat account, we are dealing with the electronic form of the securities over there, and also there is reduction in the paperwork because you are basically involved in dematerialization process, and there is reduction in the transaction cost, nomination facilities available over there. So these are the benefits of depository services. Okay, other than the banks may also offer the factoring services. Now what is the case of factoring? Let's take the case that here we are having a particular firm XYZ who has actually sold the goods to different persons A, B and C, but it has sold it on credit, and further the amount is due of rupees 10 lakh, but after 3 months 10 lakh is due after 3 months, but XYZ do require the funds right now. It do requires the funds right now. So what it will be doing? It will be let's say it visited a firm which is a factor. Now what factor will be doing? The XYZ will be assigning the book debt. So the amount which is to be received, this is actually related to the account receivables, or we can say book debts over there. So particularly XYZ will be assigning this actionable claim of book debts or account receivables in the name of factor, and factor on instance will be providing a liquidity. Let's say from 80% to 90% liquidity will be provided at the same instance, right? And further, now factor will be, the factor is able, or factor is actually the beneficial owner so as to manage this particular debt over there, and after a particular period of 3 months the factor will be recovering the amounts from these particular persons, right? And the extra amount or the margin amount that was particularly pending, that will be paid after deducting its charges. Okay, so that's the scenario related to factor over there. Now in this scenario, XYZ actually converted its credit sales into the cash sales. Previously it was the goods were sold on credit, and for the XYZ was to receive these this particular amount after 3 months, but now XYZ has actually converted this credit sale into cash sale over there. That is the first thing, that is the first benefit of factoring. And the second benefit it's related to that the XYZ is not to manage these particular accounts. Now the factor will be managing the recovery processes itself, right? So these are the benefits which are available over there. And this kind of factoring, this is actually the whole process of factoring over there. So over here we are having the client, we are having the financier, okay, that is the main thing related to it. Okay, and further the factoring services can be with recourse, it can be with recourse, or it can be without recourse. or it can be without recourse. When I say that it is with recourse, what does it indicate? It indicates that in the event that when a factor tried to recover the amounts from ABC persons over here and they defaulted, in this scenario, factor can actually be asking XYZ so as to pay the amount, so as to compensate the amount, right? That is actually with recourse. And in case of without recourse, if XYZ ABC never paid the amount to factor, in that case factor cannot be asking the XYZ so as to pay the amount over there, right? That's actually without recourse. Okay, now let's have a look at the RBI guidelines on factoring services. First of all, it's related to the through a subsidiary. So bank wants to offer the factoring services. Let's say the bank whosoever wants to offer the factoring services, they might be establishing a subsidiary company specifically for this particular purpose. And let me tell you, the aggregate equity investment, let's say ABC Bank wants to basically do business in factoring business. Now in that scenario, they need to set up a subsidiary. Let's say they set up the SUB, and the aggregate equity investment by the bank in this subsidiary cannot be exceeding the 10% of the bank's paid up capital and reserves. So whatsoever the amount of the bank's paid up capital and reserves, the total investment in this subsidiary cannot be exceeding the 10% of the same, right? So that's the main condition. And after that, it's related through departmentally. So now the factoring services can also be offered departmentally, where the particular department of the bank will be offering the factoring services. So dedicated department will be responsible for handling the factoring transactions and related activities over there. So factoring services shall be provided on recourse or without recourse or limited recourse basis over there. All underwriting commitment pertaining to the credit risk on debtor under without recourse factoring shall be in accordance with the board approved limits over there. What does it indicate? It indicates that the bank can be undertaking, even if the factoring services are being provided on departmentally basis, the bank can be undertaking those services on with recourse basis or without recourse basis. But if it is on without recourse basis, whatsoever the risk which is involved and further whatsoever the risk that you are taking, we are actually dealing with, that must be in accordance with the board approved limits over there, right? And further, factoring services for invoices representing genuine trade transaction, only to deal with the genuine trade transaction, and no kite flying transaction must be used for such. It's not the case that A has not sold any physical goods to person B, but A has generated an invoice on person B, and they were basically on the same side. They were basically on the same side, and for the based upon the same, A went to the factor and took a loan from the financier or from the bank over there, from the factor over there, and ultimately the funds were used by both of them, right? So this could also be the case, but this should not be done. This should not be done. It should be related to the genuine trade transactions only, right? And factoring shall be treated on par with loans and advances. So whatsoever the provision is to be maintained and whatsoever the IRAC norms are applicable, those will be applicable in the same manner in the case of the factoring also, right? And further, related to any of the transaction done under the factoring, that must be reported to the CIC, that is a credit information company over there, right? Further, it's related to TREDS. Now TREDS is Trade Receivables Discounting System. TREDS is Trade Receivable Discounting System. TREDS is an electronic platform. It is what? It is electronic platform where it will be facilitating financing to the micro, small, medium enterprises for the trade receivables. So discounting of these trade receivables will be done and financing will be provided to the MSME through the online platform, which is TREDS over there. There will be multiple financiers which will be available. So we can just understand this from this particular picture. Let's have a look at it. So on the TREDS platform, we'll be having the MSME suppliers who have supplied the goods and further their amount is due, and also we are having the buyers who have actually going to buy the particular goods over there, and also we will be having the financiers. So buyers will be purchasing from the MSME suppliers, and there will be invoices which will be raised, and those will be financed by the financiers over there. Those will be financed by the financiers over there. That's the main scenario related to TREDS. That's the main scenario related to TREDS. So these receivables can be due from the corporates or from the other buyers over there or from the public sector undertakings. So RBI, Reserve Bank of India, launched the TREDS, that is a Trade Receivable Discounting System, in 2014 over there, so that whatsoever the credit challenges which are being faced by the MSME sector in India, those can be dealt in, right? So that was the main reason. Now after that, it's related to other agency businesses by the banks. It's related to SGB. SGB is actually the sovereign gold bonds. Now these are the government securities which are equivalent of the gold. So rather than basically investing into the physical gold, now you can be purchasing the sovereign gold bonds, and it's equivalent to the physical gold, equivalent to purchasing of equivalent gold, physical gold over there. And you can be purchasing even 1 gram of the SGB bond over there. SGB bond over there can be purchased, and it is denominated in grams of the gold over there, right? And it's a substitute for the physical gold. And what is the main feature? That whatsoever the amount that you have invested, let's say case I invested rupees 6 lakh in SGBs. Now in that scenario, I'll also be earning whatsoever the amount that will be increased in the prices of SGB. That is a benefit that will be available to me. Other than that, I'll also be getting 2.5% per annum on half yearly basis. 2.5% per annum on half yearly basis that will be paid to me, right? Eligible investors may be individuals, HUF, corporates, trust, etc. Those are particularly what? Those are eligible investors. HUF, trust, universities, charitable institutions, those are actually eligible. So individuals or others can be investing minimum of 1 gram, and for the maximum, individuals can be purchasing 4 kilograms. For that is actually limit available for from 1 gram to 4 kg. This is a limit that is there available for individuals and HUFs. Individual and HUF. And if we're talking about the trust can be purchasing 20 kg of the SGBs, 20 kg of the SGBs per fiscal year. And that's after that it's related nominal value of the bond. Now the nominal value of the bond actually will be fixed upon what? Let's say case that when the bonds were issued, the price of the bond was 56,000. Let's say case now the gold price is increased. Now it will be an average price which will be issued by IBJA. IBJA is Indian Bullion Jewelers Association. So whatsoever the average price which will be issued by the IBJA, based upon the same, the bond price will be there, right? So premature redemption of the bond is actually permitted from the 5th year of the date of issue, right? So premature redemption is allowed, but after the 5th year. But from the 5th year, not after but from the 5th year of the bond issuance date, right? And further, these bonds are having an expiration after 8 years from the date of issue. Okay, and these bonds are tradable and can be used as collateral for loans from the banks and financial institutions. Okay, so that is related to SGB over there. After that, it's related to APY, that is Atal Pension Yojana. Now, Atal Pension Yojana scheme was implemented with an objective so as to provide the pension benefits in the unorganized sector. So if there are individuals in the unorganized sector, let's say case who are on daily wages or something, and further if they want to take the benefit of the same, APY scheme is there which can be providing them with the monthly pension up for rupees 1,000 to up to rupees 5,000 over there. The person is to make contribution, and for the person aged from 18 years to 40 years can be participating in this particular scheme over there. And further, let me just give an example. Let's say case person A is there who is aged 18, and further he wants to receive a pension of rupees 1,000 per month after he attains an age of 60 years. In that scenario, he is to start contributing rupees 42 per month for up to next years when he will be attaining the age of 60, and after that he will be receiving rupees 1,000 per month in his account, right? So that's the case. And further, this scheme is regulated and controlled by PFRDA over there. And what are the different features of APY? Let's have a look at it. So there is guaranteed minimum pension that will be paid to you. Guaranteed minimum pension means what? That if you have enrolled into 1,000 rupees scheme, that you will be receiving at least rupees 1,000 rupees per month. And if you have basically enrolled for 5,000 rupees scheme, you are to basically contribute that particular amount, and accordingly you will be receiving rupees 5,000 per month over there after attaining the age of 60, right? And minimum pension amount to the spouse. Now let's say case person enrolled into the scheme, and further he paid the contribution, and he is now aged 60. He was aged 18 when he enrolled, and he is now aged 60, and further he continued to receive rupees 5,000 rupees per month. He continued to receive rupees 5,000 per month, and he died at the age of 66. He died at the age of 66. Now, even after the death of the particular person who basically started his APY scheme, the spouse of person A, let's say person B is the spouse of person A, she will continue to receive the minimum pension amount even after the death of the main account holder or the subscriber over there, right? And further, even after the death of the spouse, the nominee under this particular subscriber scheme, they will be receiving a lump sum amount. Over there, right? That's the case related to it. And further, eligibility for the co-contribution by the central government. So Central government actually said, because this scheme was started in 2015 over there. So whosoever the previous accounts were there, central government said whatsoever the account which will be opened in the first year of the scheme, they will be eligible for the co-contribution from the Indian government for the next 5 years, right? So that was related to it, and that is all about the APY scheme over here. Okay, so that will be all related to this particular video. I hope that you must have enjoyed the content of this particular video. So do rate this video out of 10, and don't forget to share this video and like this video. So do like this video and share this video among your friends and colleagues who have been preparing for JAIIB 2024. So that is all. Thank you so much, and see you again in the next video.